Hello and welcome to the Paris Fintech Forum Communities Programme. I'm Elliot Gotkin, I'm a journalist and with Laurent Nisri, co-host of this exclusive video interview series produced with the support of Solaris Bank, Rise and BPI France. Today I'm joined by a serial entrepreneur who heads up perhaps the most valuable insurtech on the planet. Its IPO in 2020 was one of the most successful debuts of the year, and after conquering America, it's now open for business in France and rolling out across Europe. So please join me in welcoming Lemonade co-founder and CEO, Daniel Schreiber. Daniel, great to see you again. How's it going where you are?
Counting our blessings. It looks like the worst of the pandemic is hopefully behind us. So as spring approaches, feeling increasingly optimistic. Thanks for asking.
Great. Lemonade, I guess, is a kind of anti-insurance insurer for the millennial generation. What sets it apart? What sets it apart from other insurers and indeed other insurtechs?
Well, we try to rethink a lot of the fundamentals of the insurance industry, really starting from the incentive structures and the business model themselves. We found that people distrusted insurance, which was not obvious. It's a business that is all about helping people in their hour of need. Why is that one of the most distrusted industries on the planet? And we worked with behavioral economists, with game theory, Nobel laureates, and others to try and figure that out, and came to the conclusion that a lot about the business model itself elicited that kind of distrust, which then leads to loads of ills. Distrust means low brand loyalty, high churn, a lot of fraud. So we built the business model from scratch on top of new insurance companies that we established in Europe and the US, and then added technology so that the entire company runs in an automated fashion. Whether you're buying insurance, you buy it in seconds. It costs you oftentimes half of what it would otherwise cost, and claims can get paid in 3 seconds. And that is really the outcropping, the result of rebuilding everything from scratch, both in terms of business model and technology.
Right. And of course, I mentioned in the introduction, you had your IPO in 2020. It was a resounding success. Lemonade is now worth about $9 billion. Are you shocked at how rapidly the shares have risen and the valuation has soared?
I try to self-talk and to talk the rest of the team into not looking too much at the stock price. We're on a long-term journey. Insurance is one of these stunning businesses where the leaders of the industry do over $100 billion a year, and they've been around for 200 or 300 years. So this is a prize that is just stunning in its proportionality. And we really are barely scratching the surface. We're a very young company, having just hit our 1 million customer milestone. We've got a long, long way to go. So whether ultimately the share price in 9 months after IPO is here or here or here is, in the scheme of things, really unimportant.
But it does help you in a way, because rising shares, for example, enabled you to go for a secondary offering. I think you personally sold some shares in that. Does the valuation put more pressure on you? Does it affect your outlook? Are investors now kind of demanding more success faster to justify that valuation?
It definitely does help us in that we were able to raise a lot of money without incurring too much dilution. And we did that. So the company now has over $1.2 billion in the bank, which is a very empowering place for us to be and gives us a lot of optionality. It also allows us to lean in more to growth opportunity as we identify them. But it doesn't create the kind of pressures that you're alluding to. The valuation is an expression of the fact that people believe that we're going to do bold and big things over time. So I don't think it's the result of the valuation. It's the other way around. The expectations that we have of ourselves are projected onto the marketplace and yield the kind of valuations that you're seeing.
Right. And although Lemonade wasn't really caught up in the whole kind of Wall Street bets, GameStop flurry of hugely soaring shares, but at the same time, some people would suggest there is a bit of froth in the markets, and that has kind of pushed certain companies higher than perhaps are justified. Do you again just kind of block that out and just focus on what you're doing?
We broadly do, yes. My own Lemonade aside, my own interpretation of what's going on is slightly different. I think this has a lot to do with the low to negative interest rates. If you buy an inflation-adjusted 30-year bond from the German government to the British government, you're guaranteed to lose money. And when you think about 30-year time horizons of parking money, and you know that you're going to lose money by putting it in bonds, paying for future growth of tech companies or other companies isn't an irrational thing to do. So if you used to apply a kind of discount to what this company might be worth in 5 or 10 years' time, today that discount is minimal to non-existent, and that allows you to rationally pay a lot more for the future state of a business today. And I think that's driving a lot of what we see in the stock market today. So not necessarily irrational, certainly unconventional.
And of course, these have not been conventional times with the pandemic. How has COVID affected Lemonade as a business? Have you seen a kind of digitization boost like many other fintechs out there, or has it been broadly neutral?
I think it's been broadly neutral. I hesitate simply because so much has changed in Lemonade during this time, regardless of the pandemic, that it's hard to create a kind of clean A/B test. So we've seen very, very rapid growth, but we were seeing rapid growth before the pandemic hit. It's continued throughout the pandemic. We've seen rapid improvements in unit economics. Every dollar that we spend on marketing goes approximately twice as far now as a year ago. So you say, oh, wow, the pandemic has increased efficiency of digital acquisition. But we were seeing that trend line before the pandemic hit as well. So we are seeing continued rapid growth and improvements in all of our key performance indicators. But it's hard for me to truly and objectively parse those out and say to you how much of that is despite the pandemic or because of the pandemic. It is something of an anomaly in that sense. We see some companies, Zoom and others, that have done spectacularly well, clearly driven by the pandemic. And then you ask yourself what's going to happen when that pandemic passes. And conversely, you see the airlines hit devastatingly because of the pandemic. And you ask yourself what's going to happen to them once the pandemic passes. I think our big takeaway is that Lemonade seems to be a very resilient business in a resilient sector. We're selling products that are needed in good times and in bad, and tends to be counter-cyclical in that regard. So I think with some caution, I would say that we were improving before the pandemic, during the pandemic, and hopefully we will see those trend lines continue after the pandemic passes us by.
Right. Now you personally, Daniel, you come from a family of entrepreneurs. I mean, your brother is CEO and founder of Freightos, and I'm pretty sure when I was growing up in the UK, I saw ads for Schreiber kitchens, which I think was part of your family. Did you always know you wanted to go down this route? Because I think you started out life as a lawyer.
Yes, I consider myself a recovering attorney. I was a lawyer, qualified, bar exams, the whole lot, but I didn't even practice for 1 year. So I became an attorney in the mid-90s, late kind of 96, I think, maybe it was. And during 96, 97, these were the heydays of the dot-com explosion. And it turned out that I was perfectly credentialed to found a startup, because if you knew nothing and had no experience, that's exactly the job requirements for starting and getting funded for a startup in around 96, 97. So I left my law firm and started my first startup then. And it was very fortuitous for me. I just had the good sense to be born in a year that then correlated to coming of age during the dot-com bubble. So that was great. Started my first startup, and I've really been in tech entrepreneurship ever since. And to your question, yes, I think I got a lot of it kind of with my mother's milk. So my grandfather, who came as a penniless refugee to the UK, he was an artisan, and he knew woodwork, and he established a furniture company that became Schreiber Furniture, which people from your age and mine still remember from the UK back in the day. And it was certainly something that I imbibed at home, and my siblings are entrepreneurs, and my father was an entrepreneur. But one never self-conceptualizes that way. So I thought of myself as not being like that. I was going to be an attorney. I was going to be a professional. And that lasted for 5 minutes.
Right. Yeah, so many founders tell me, that they just wanted to do something that wouldn't mean becoming an accountant or a lawyer. So many have escaped. I mean, Lemonade, as you mentioned, isn't your first stab at founding a company. If I'm right, your first one was called Alchemedia. You were also president of PowerMat, although not a founder of that one. Do you see those as, with the benefits of hindsight, as successes, as failures, or just good lessons in entrepreneurship that helped you get to where you are today?
No, I think a big chunk of what I've done in my career has not succeeded. My first startup was sold, but it was a fire sale, and the investors who invested in it did not see a return. The technology lived on, and ultimately the team and the technology were licensed to Microsoft and became something. But in terms of any kind of objective metric, it was not a successful investment. The same investors who invested in me in '97 got to invest in Lemonade, and some of them made 100 times on their money. So, there's some karma, and what goes around comes around. They were all wonderful lessons for sure, sometimes at other people's expense, just because of the nature of the industry. And for me, it's been a lesson in humility and in just attributing a lot of success to serendipity and luck. So Lemonade has been hugely successful for me, for my family, for the Lemonade family, more broadly speaking. And it may be that I am so many percent better at what I do today than I was back then. But the success has borne no correlation that I can identify in terms of those percentages. So a lot of good fortune, a lot of good timing, a lot of good luck.
Okay, well, don't go away, because we're going to take a very quick break, after which we're going to continue our conversation with Daniel Schreiber, co-founder and CEO of Lemonade. Welcome back, and don't forget, if you're not already a full member of our community, everything you need to join can be found at www.parisfintechforum.com. And now, Daniel, I've got a few more questions for you, so why don't we take a slightly deeper dive into the insurtech ecosystem. There's a flurry of insurtechs planning IPOs in 2021, including our friend Asaf Wand at Hippo. Is this the year that insurtech really comes into its own?
I don't know. And I'm not sure what that means, comes into its own. We're certainly seeing a very favorable funding environment. And I think that's great for the industry. It's been surprising to me how little activity there was over the last 5 years. So when Lemonade was founded not that long ago, just over 5 years ago, the term insurtech didn't really exist. Certainly I'd never heard it. And I'd like to think that Lemonade has been part of a broader effort to popularize the notion that there is just stunning amount of innovation that this industry is hungry for. And for reasons that I said earlier, a prize worth fighting for. When you have an industry that accounts for 11% of GDP in the United States and is $5 trillion worldwide and is largely unchanged for the last 100 years, that rarely comes together and should excite entrepreneurs and investors. So Lemonade went public in July, a young company going public, the first perhaps of the insurtechs to go public. But we have seen that perhaps in part we opened those floodgates, but we have seen a flurry of activity with Root going public and Metromile going public through a SPAC. And as you say, rumors about Hippo and others following suit. And I'd like to believe that that's all good news for the industry, that whether the share prices in the short term go up or down, the idea that money can be made investing in innovation in insurance is just a thesis that has to be true. Not every investment will pay off, but as a swarm, I'm sure these companies are going to continue to be very, very impactful indeed. The reason I hesitate about giving you an answer of one syllable is just that the incumbents are so big and so established and so dominant that I don't expect 2021 to be the year that they implode. This is going to be a journey. It's going to be a decades-long journey of continuous progress of innovative solutions that slowly eat into the very dominant market share of incumbents. So anybody expecting this to be one of those poof, the old guard goes, the new guard comes in, that's not going to be the dynamic. It's going to be, I think, much more similar to an Amazon that 20 years later you see, wow, I wish I'd invested them in 1995 and not in Walmart. And you see how they continuously become more and more distinct from the incumbents. And yet high street stores, even though they've taken a hit, even though they've taken a setback, they do continue to exist as a category.
Right. And just briefly, if you could, Daniel, I mean, you talked about there being a lack of innovation for like a century in insurance, and now we've got a flurry of it. How much more room for innovation is there in insurance, and what kind of trends do you see gathering pace in the coming year?
Oh, I think there's a great deal. Insurance is not only 11% of GDP, it's really the underpinning of so much of society. You go on vacation because you feel insurance is going to cover you and you're safe. You get a job that you might get sued in to become a doctor or a pilot or whatever it is, because insurance gives you that peace of mind. You join a board of directors for that same reason, because insurance shields you from what might occur. So it really is one of those things that enables society to operate. And then you've got life insurance and health insurance and all these other sectors. So I think if you think about insurance as almost being a safety net of society at large that allows entrepreneurship and leisure and family to flourish, you realize just how powerful a sector this really is. And thought about through that prism, there is endless innovation that you would do in travel and in health, and in every other sector, obviously homes and transportation, which is undergoing, mobility is going through once in an eon style transformation. All of these have insurance dimensions to them, where newcomers, legacy free, built on the same kind of digital substrates that the companies they're looking to help are built, can be massively transformative. I've little doubt of that.
Okay, well, we look forward to seeing Lemonade being a part of that transformation going forward. But I'm afraid we're actually out of time, Daniel, but it's always a pleasure to speak with you. So thank you again, Daniel Schreiber, co-founder and CEO of Lemonade, for joining me today.
Thanks, Elliot. Good to talk to you.
And I'll be back next week with another big name from the world of finance and technology. We hope you'll join us again then. In the meantime, you can keep up to date with all the exclusive interviews and content from the Paris Fintech Forum Communities Programme via www.parisfintechforum.com. Thanks for watching. That's it from me. Bye-bye.